Welcome back to Investing Talk Podcast.
Today we're looking at Adecoagro.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And this one is really interesting because Adecoagro is at a critical point right now.
Major junction, yeah.
Exactly. If you just, glance at the recent numbers, you see a business that looks like it's under some pretty clear pressure.
Right. The top line for the first 9 months of 2025, it was what, just over $1 billion?
Yeah, about $1,012 million.
Yeah.
Which is, it's a noticeable step down from the year before. That was closer to $11,145 million.
Okay, so that's a pretty significant drop. What's driving that?
It's really two things. First, you've got weaker prices for agricultural commodities just across the board. And second, management was actually pulling back on some sugar and ethanol volumes because of that pricing. So on paper, it definitely looks like a slowdown.
It does. But this is where it gets interesting, because if you stopped at revenue, you'd miss the real story.
You'd miss the most important part. Because despite that big sales drop, their adjusted EBITDA for the third quarter was actually up.
Up. Oh, wait. So sales are down, but the core profitability is up.
Up 3.7% year over year. It hit $115.1 million.
That feels counterintuitive. How do they pull that off in a commodity business?
It all comes down to really smart operational management. They've got tight cost controls. But the real key was their product mix.
Okay.
They made a very specific strategic shift in their sugar, ethanol, and energy segment. They basically decided to maximize ethanol production, which had higher margins, over raw sugar.
And that paid off.
It paid off big time. Their Q3 adjusted EBITDA margin just soared to 37%.
37? And what was it before?
It was 25% in the same quarter last year. So that just shows you the kind of operating leverage they have baked into the business. They can pivot to what's most profitable.
That is a strong sign. But we should also, frame that against the bigger picture, because the market isn't fully convinced yet.
No, not at all. The consensus forecast for the full year 2025 EBITDA is still only around $400 million.
Which is a huge drop from the $569 million they did in 2024.
And that reflects that ongoing price pressure and probably some of the initial drag from the massive acquisition they just made.
Right. And that brings us to the real catalyst, the thing that changes this entire story. The Profuttle deal.
This is the game changer. It's not an exaggeration. Adecoagro is buying a controlling stake, about 90% in Profuttle.
And Profuttle is what, the biggest fertilizer producer in Argentina?
It's the leading nitrogen fertilizer manufacturer, yeah.
Yeah.
This is not a small bolt-on acquisition. It's a structural transformation of the entire company.
The numbers they're projecting are just huge.
They're dramatic. The company is saying that once Profuttle is fully consolidated, it'll push their pro forma sales over $2 billion.
And the EBITDA.
It's expected to nearly double.
Yeah.
That's a massive injection of new earnings power.
So it's not just about getting bigger. This is about getting fundamentally stronger. You mentioned a competitive moat.
Yes, and that's the real story beyond the numbers. They're changing from being just a cyclical commodity producer, vulnerable to swings in sugar prices, to becoming this integrated farm-to-fertilizer platform.
Okay, break that down. What does that actually give them?
It gives them two massive advantages. First, they get direct access to nitrogen fertilizer, which is a critical input for their own crops. They're essentially hedging their own input costs.
So they insulate their farming business from the crazy volatility we've seen in fertilizer prices.
Precisely. And second, they're buying what is basically a quasi-utility.
A quasi-utility?
Yeah, think about it. Large-scale nitrogen manufacturing has incredibly high barriers to entry. You need massive capital, permits, feedstock access. It's not something a competitor can just decide to build tomorrow. So Profuttle provides this steady, durable, high-margin earnings stream that's much less volatile than farming.
It's an anchor for the whole business.
Exactly.
But an anchor that size doesn't come cheap.
Which brings us to the big concern that you hear from the market right now, the leverage.
Yep, that's the bear case in a nutshell. Net debt is up to $871.5 million. And S&P, they're expecting the leverage ratio to peak at a pretty steep 4.7 times by the end of 2025.
Almost 5 times their annual cash flow. For an ag company, that is. That's definitely in the high-risk zone.
It is, and it's why S&P downgraded their debt to non-investment grade status. It means their borrowing costs go up, it gets a little harder to refinance. It's a real headwind.
But the company saw this coming, right? They didn't just pile on debt.
No, and this is the critical part. They executed a $300 million equity issuance at $7.25 a share, to help pay for the deal.
So they brought in cash from shareholders to de-risk the balance sheet.
Materially de-risked it, yeah. It showed they were being responsible about managing the strain, and this high leverage isn't expected to last.
What's the timeline for getting it back down?
The market expects it to fall back to around 3.0 times in 2026. Okay, so that's once Prefertil's cash flows are fully online and they start seeing some of the synergies.
Exactly. The risk is front-loaded and temporary, assuming the integration goes to plan. And even now, the underlying business is generating cash. Operating cash flow for the first 9 months of 25 was still positive, which gives them flexibility.
So that brings us back to the market sentiment. It feels like you've got this very bearish view focused on the S&P downgrade, the peak debt, the Argentina risk.
You do. That's the backward-looking view. But then you have this incredibly bullish signal from the people who know the business best.
The insiders.
The insiders. The controlling shareholder and the management team, they didn't just sit on the sidelines during that equity raise. They stepped up and bought a big chunk of it themselves.
At that $7.25 price point.
At $7.25.
Yeah.
That's a massive vote of confidence. When management puts their own money into a deal at a specific price, that tells you everything you need to know about what they think it's worth long term.
And for investors, that creates a sort of technical floor, doesn't it? That $7.25 fine price acts as an anchor.
It's a huge psychological and technical anchor. It's just above the recent 52-week low. It suggests that this whole zone, say between $7 and $7.25, is a really constructive area where strategic capital has already shown up.
So what's the next big thing the market is waiting for?
The next major catalyst will be the full year 2025 results. They'll probably come out in February or March. That's the first real chance for everyone to see how the integration is progressing and, most importantly, get updated guidance for 2026.
And we do have to mention the risks again, because they are real.
Absolutely.
Yeah.
You still have exposure to volatile commodity prices. That hasn't gone away. And you have country risk with Argentina FX controls, macro policy. Those are things analysts are rightly pointing out.
It's a story that requires patience.
It definitely does. But the argument is that the stock is currently depressed because of these temporary issues, the weak commodities, and the optics of the high leverage. But the company underneath is being structurally transformed into something much stronger.
This new diversified farm-to-fertilizer and bioenergy platform.
Right. And as Profitil's cash flows come in, that upside could be really compelling. This is not a short-term trade. It's framed as a 2 to 4 year story.
It really is a perfect example of that split between short-term market fear and long-term strategic alignment. And when you see management buying shares at 7.25, you have to wonder if the market is too focused on the temporary debt and completely missing the permanent shift in earnings power. It really makes you think, what does management see that the broader market is currently ignoring?
It's the central question.
If you appreciated this analysis, make sure you're subscribed to the show so you can catch our next one.